Good afternoon, everyone. This is Jim Kruzan, and this is just a brief update on what transpired for the month of January. I'm here actually in Scottsdale, Arizona, finishing up a three-day conference for it was the Elite Advisor Wealth Summit, and a lot of great information, saw a lot of great people as well. So here it goes. As we've said many times before, we're following the data. And this data is going to lead typically to one of two things. The data will continue to show weakness until we go into a recession, and those things happen quickly, very abruptly. It's not like landing an airplane on a long runway. Or the data will start to show improvement, which would be more in line with a soft landing scenario. I wish I could say we're clearly seeing one or the other. Data has been for quite some time a bit of a mixed bag. In both cases, we've been hoping for a broadening out of the market, whereas the performance isn't all Magnificent Seven. And sadly, for most of last year, remember the December update, and for frankly, most of the year before, we saw quite a bit of the performance of the market, especially the S&P, being a direct result of the performance of the Magnificent Seven. While 1 month is not by any means a trend, we are beginning to, as you'll see in a few moments, a bit of a broadening out, which is somewhat encouraging. But the data still is really quite mixed. Let's look at a few slides. We're not going to go through a lot of them today. The LEI, the leading economic index, continues to drop, continues to have a really negative looking graph. In fact, while there was a slight uptick in November, there was an immediate big drop once again in December. So the trend clearly has been downtrending. And as I said before, this has always been held out as a huge leading indicator. It has always, without fail, led to an indication of a recession. Clearly, we don't have that yet, but the data continues to look negative, still somewhat cautionary. In addition, there's some really craziness going on with respect to the yield curve. The yield curve for quite some time has been inverted, and now we're seeing that the yield curve is pronouncedly upward trending, like it should be. If we look at where the blue line is now, that would be as we see it right now in February. The yield on a 1 month rate is clearly a bit less than the yield on a 20-year bond rate. So the longer you go out, the higher the yield is that's expected. If we consider where we were just a year ago, dark gray line beneath, clearly interest rates were quite a bit higher on the short end. That's cut rates a full percentage point since then. And we will also notice that the long-term rates were actually somewhat lower than where they are today. So all the while the Fed has been pushing down on interest rates, long-term rates have been rising a bit. Some of that is concern about the upcoming administration, what impact tariffs or immigration concerns would have on inflation and subsequently long-term bonds. So this yield shift, making it a bit more normal, is doing some strange things as we are actually seeing today higher yields on the 10 and 20-year bond rate than we had before they first started cutting rates. Clearly somewhat abnormal. The other thing is we have a real high valuation in the market. I'm not going to go through a lot of information on this, but the old Buffett indicator, which kind of tracks market value to GDP, is currently sitting at about 200% of GDP, which historically has been extremely high and prone to large pullbacks over periods of time. And as recently as just the end of the year, December, just a month ago, this Buffett indicator was at historic high levels. So while we have some cautionary economic data, we also have some cautionary stock market valuations. But it's not just the macro data, like the yield curve or the leading economic index, we're seeing a lot of micro data, which is at best somewhat of a mixed bag. While we talked about macro data, such as the LEI and the yield curve, let's focus in on some of the more high frequency data. This is that's updated a bit more often. We talked about the LEI dropped again in December, but just as it dropped and it continues its negative ways, when we start to look at the rate of change the last 6 months versus the 6 months before, it has slowed down a bit. The rate of decrease is softening. Don't know if that's an aberration or whether it's more of a trend. We will see. As of last month, the current 6 months still fell quicker than the prior 6 months. So this data changes quite a bit. Credit card delinquency rates, really high. 1 out of 9, or about 11%, are 90 days late. That's something you typically see in a healthy economy. And commercial mortgages, the CMBS, their default rate is well in excess of 11% as well. Again, much higher than we would expect to see. And by the way, the highest level of delinquency ever recorded for commercial mortgage-backed securities. If we look at some additional data, we'll see, again, this mixed bag. While we see the ISM manufacturing number ticked up a little bit in January, the global service number ticked down a bit. The factory order number, new orders dropped quite a bit in the most recent month as well. If we look at additional data, the Chicago Business Barometer, which covers business activity in the Midwest, dropped again in December, and non-factory orders were a bit weaker as well, and the Empire State Manufacturing Index dropped again in January. So we're seeing all these different things, some weaker than others, kind of a mixed bag. And then last but not least, you're seeing a lot of the economic numbers that relate to inflation generally ticking up a little bit. So you've got a bit higher inflation, which causes some degree of issue should the economy slow down, and a mixed bag on certain data points that are showing slight improvement in rate of change, or flat out a continuation of its negative ways. So turning now to the market for the month of January, again, a bit of a mixed bag. While December, if you remember, was all negative, it was kind of a reversal of November. We started to see the market once again broaden out a little bit. So it's not just the S&P. If you remember in December, and for the quarter and the year, the S&P was performing so much better than many of the other market components, and certainly better than an equally weighted S&P. For the month of January, just the opposite. The equally weighted S&P is performing better than the S&P, which is cap weighted. The Dow Jones Industrial Average is performing even better. The NASDAQ Composite, which really led the charge the last 2 years, is performing weaker than all of the above. And now we're also beginning to see the international markets that have been really quite weak the last 2 years starting to perform a little bit as well. Bonds are still somewhat flattish. Not seeing a lot of return coming off of bonds. That can also have something to do with the yield curve starting to righten, and the higher terms are becoming more expensive in terms of higher yield. But just the same, things are beginning to broaden out. And with our somewhat defensive portfolio, with some exposure to gold and silver, etc., the account is holding up really quite well. And you'll see at the bottom of the page both what the 60-40 US and global is doing. We're beginning to see actually the global market starting to outperform. So we'll watch this very closely as we move here into February and beyond, and report on this as well. I mentioned that the markets are broadening out, which means we're not getting the participation as we've had the last 1.5 to 2 years with the Mag 7. There is some degree of pressure on those, as witnessed by the performance in January. So let me just share that with you as well. So here we are in January. Here's the performance numbers for the Mag 7, Microsoft, Apple, Google, Amazon, NVIDIA, Meta, and Tesla. And the weighting of those 7, and still today, those 7 through the end of January represent nearly 34% of the index. The top 10 stocks in the S&P still represent nearly 40% of the index. By comparison, during the dot-com bubble in the year 2000, the largest 10 stocks, the most inflated 10 stocks, represented just 20% of the index. Gives a magnitude of just how big the balloon has been. I had mentioned that the S&P for January was up about 2.7%, and you'll see that on a weighted basis, the Mag 7 actually contributed a slight loss to the index. As a group, they were actually down 4/100ths of a percent. Certainly fractional, but just the same, not 2 or 3 times what the index has been, which has been more the norm than the exception. So that was the month of January. Markets are beginning to broaden out. We'll see if that continues. We're watching a lot of the other issues concerning the market, inflation, the effects that some of the rolling out of the present Trump administration policies would have on the economy as well. And we'll keep you posted. And we expect to see you again here at the end of February. If you have any questions, by all means, reach out. Once again, thanks so much and make it a great day. See you soon. Take care.